Analysts say Singapore's GDP growth this year will be in the lower half of the forecast range of 0.5 to 1.5%. And that's despite the faster than expected 0.7% expansion in the third quarter. Still, the forecast is in line with MAS statement. It points to muted prospects in the near term, which should gradually improve in the second half of the year. Risha Matthew takes a closer look at the Q3 numbers.
The manufacturing sector remained in the doldrums, shrinking by 5% on year. The Trade and Industry Ministry says the weak performance was due to output decline across all sectors except for transport engineering. But the worst seems to be over as the sector expanded 0.2% on quarter. Experts say this would point to a recovery in the fourth quarter.
I think if you look at other countries such as Vietnam, Taiwan, Korea, you do see that it seems like global electronics demand is bottoming out and starting to pick up again. So I think that would benefit Singapore's manufacturing sector, given that electronics makes up a hefty 40% share.
But the recovery could be gradual and fragile.
One reason is that the key electronics sector is still not on a firm footing, and the global economic environment remains uncertain. So interest rates are still high in advanced economies, and China's post-pandemic recovery continues to be quite bumpy, even though the authorities there are putting in some stimulus to cushion growth.
The construction sector remained a standout, growing by 6%, extending its 7.7% on-year growth in the second quarter. MTI says both private and public projects contributed. The services sector, which accounts for about two-thirds of the economy, expanded at a slower pace of 1.9%. With only the final quarter remaining, analysts don't expect the overall numbers to differ very much.
Given that even with an improvement in growth in the fourth quarter, I think that our forecast is still for GDP to grow by 0.8% this year. So that would actually be in the lower half of the forecast range.
In terms of numbers for 2023 growth, we are expecting 0.9%. And 2024, we are expecting growth to pick up slightly to 2.2%. But I must caution, though, that risks to the growth outlook are, however, still to the downside.
They point to high interest rates in the advanced economies as well as uncertain geopolitical developments.
For more, we speak now with Barnabas Gunn. He's acting Group Chief Economist at RHB Bank. Barnabas, we see the Singapore economy growing at the lower half of the forecast. The concern here is the possibility of economic crisis. Should we be preparing for that at all?
Hi, good evening, everybody. Thanks for having me on the show. I think essentially what we see is that global growth momentum is actually improving as we speak. We are seeing green shoots really in key economic indicators in developed economies such as the US, and Singapore being a price taker, and a small and open economy, we are very reliant on how global growth is actually expanding, around the world. Essentially, we are already seeing good data out from the US. This is really very much seen in the labor market, consumer spending, and I think what is also encouraging in Asia as well is that we are seeing very early signs of recovery in Chinese-centric numbers. And this is really led by the unemployment rates, as well as retail sales, consumer expenditure, consumer confidence, and there is a very slow but gradual pickup in momentum in Chinese trade. And what we have already seen as well, that the electronic sector, the semiconductor sector in general, although still on a year-on-year decline, it's picking up from a momentum perspective. So I think in short, we are seeing green shoots in the global economy. And if that persists, it will mean that likely the worst is over, the slowdown is likely done, and we are likely seeing a rosier 2024 story into the next year for Singapore.
Barnabas, green shoots, whether in the Chinese economy or elsewhere in the world, they could be at any point snipped off by geopolitical tensions. Of course, all today headline news, what's happening in the Gaza Strip. And of course, we've had Ukraine more than a year now of that. Are these geopolitical events likely to have much effect? Because the economy is a separate thing. It could actually feed economic growth in Singapore, in this region, and globally.
You are very right. Thank you for the question. The understanding and really the unfortunate thing is that geopolitical tensions, being political in nature, it's very hard to model from an econometrics perspective. So we can only guess, and really project as to how it might pan out. I think essentially we have seen, in history that we have so many episodes of geopolitical tensions. And I would dare say that in past experiences or past episodes, global growth as much as investor sentiments, if any, will only see a knee-jerk reaction. And this is likely going to be seen in the coming, this current geopolitical tensions. The onset of the tensions, really, as we speak, has, in our view, not dented investor confidence. We have seen the MSCI World, Index still pointing higher. We have seen U.S. equities, especially Nasdaq, crossing its the 50-day moving average, which is, from the technical terms, showing, and suggesting that investor sentiments, investor confidence still remains on the uptrend. And we have seen that safe haven flows, into the dollar, it's still not seen. The dollar is trending lower, although gold prices are increasing as we speak. But I think in a nutshell, we are saying, that the exacerbation of geopolitical tensions right now, from the whatever information that we have, has not dented investor confidence. And I hope that will continue. The caveat, which is not modeled and can't be modeled by any econometrics models at this juncture, would be any unexpected exacerbation, or intensification of geopolitical tensions that may derail, depending on how severe it is.
Barnabas, let's talk about sectors now. Which ones specifically do you think might be bright spots for the next year, and why?
Well, I would say that from the latest numbers in the GDP, I am very much confident and optimistic that almost all, in fact, not if not all, key cylinders in the Singapore economy will be firing very nicely in 2024. And why do I say this? I think first and foremost, services will still continue to pick up into 2024, given hopefully the uptick in tourism numbers, and with China coming full steam, likely into the second half of 2024, if not towards the end of 2024, that would actually give a boon to ASEAN, including Singapore, in investment flows, trade flows, and most likely than not, the continued recovery of the semiconductor industry. And from the construction perspective, we have seen that the construction sector has outperformed, as of the charts at 6%. What this basically means that all three key sectors, if I may add, from a momentum sequential growth basis, have all expanded in the third quarter numbers of this year. And this is likely to continue in the fourth quarter. And hopefully, with the recovery momentum that we are seeing from the global perspective and the comeback of China in 2024, Singapore is likely going to be on a stronger footing from the broad recovery of key sectors.
Well, in terms of business, the value of the Sing dollar, its strength, that's also been in focus, particularly over the past year and a half or so. Some say the US dollar is expected to weaken, perhaps, over the next year. Concurrently, that should happen to the Sing dollar as well. How far would that affect our attempts to fight inflation, Barnabas, if the Sing dollar were to weaken?
Well, I think there are two sides of the coin in terms of how we may deal with inflation when the Sing dollar weakens. I think what we can agree, from a global analyst perspective, is that a higher Fed funds rate will likely mean a stronger dollar, a stronger greenback, and may mean that the Asian currencies, versus the US dollar will weaken. But the thing is that Singapore doesn't only trade with the US. Singapore trade with ASEAN and around the world. So I think in Asia or in ASEAN in particular, we are still positive on the Sing dollar, given the very effective monetary policy framework that Singapore has. We are neutral on the Thai baht, and we are neutral on the Indonesian rupiah, and we are actually bearish on the ringgit and the CNH. So I think what we are seeing is that even though the Sing dollar may continue to weaken on the basis against the greenback, the US greenback, the Singapore dollar, however, may continue to stay strong against the ASEAN basket. And this basically means that from a nominal exchange rate, regime or framework, it just means that the Singapore dollar, if we consider the rest of the currency baskets across the world, will mean that the Sing dollar will still continue to stay strong into the coming year, with the 1.5% appreciation banned by the policy, the monetary policy in Singapore, means that the Singapore dollar will continue to strengthen, most likely than not, into the following year, and will continue to curb inflation pressures, imported inflation pressures.
Barnabas, thank you for that. That was Barnabas Kandeh, Acting Group Chief Economist at RHB Bank.